Let me paint you a picture of a real American family. Combined household income of $140,000 per year. 2 working adults, 1 mortgage at 6.8% interest, 2 car payments totaling $912 a month, a $420 student loan payment that has been running for 11 years, a $400 a month contribution into a 401k that their HR department told them would make them millionaires by 65. They file taxes in the 22 to 24% federal bracket, pay state income tax, FICA, and Medicare, and after every deduction clears, they take home roughly $8,900 a month. They have a Robinhood account with $4,000 in index funds, a savings account with $2,200. And they feel, genuinely and deeply, like they are one bad month away from a financial collapse that no one in their social circle would ever believe. They did exactly what society told them to do. They went to college, got the degrees, got the jobs, bought the house, invested in the company plan, signed the loan documents, paid on time, every time, and they are still mathematically trapped. Not because they made bad decisions, because they made perfectly engineered decisions inside a system that was architecturally designed to extract their capital before it ever had a chance to compound into anything real. That is not a motivation problem. That is not a discipline problem. That is a structural problem. And today, I'm going to dissect it with numbers because numbers do not lie, even when the system does. The reality they never teach you in school is that a salary is not a wealth builder. It is an engineered extraction tool. The moment your employer prints your gross income on paper, a sequence of automated deductions begins that you did not design, did not negotiate, and cannot opt out of through effort alone. Let us work through the actual math. That $140,000 household income sounds like power. But before a single dollar reaches your checking account, roughly 28 to 31% of it is already gone. Federal income tax on a married filing jointly return at that income level sits in the 22% marginal bracket, with an effective rate averaging around 17 to 19% after the standard deduction. Add FICA at 7.65% on each earner's income up to the Social Security wage base. Add state income tax, which in a state like Illinois, Georgia, or Virginia runs between 4 and 6%. When you aggregate it all, the actual capital velocity flowing out the door before you see a dime lands between 26 and 32% of gross. On $140,000, that is $36,000 to $44,800 per year, leaving in a single automated sweep. You did not choose that timing. You did not choose that destination. You did not get to decide whether that capital should work for you first and then be taxed on its gains. It left before you could touch it. Now the income remaining is roughly $96,000 to $104,000 annually, or $8,000 to $8,660 a month net. This is your actual operating capital. Now watch what happens to it. The mortgage on a median American home purchased in the last 3 years at a price of $320,000 financed at 6.8% on a 30-year term carries a principal and interest payment of approximately $2,082. In the first year of that mortgage, roughly $18,000 in payments are made. Of that, approximately $14,200 goes directly to interest. That is not wealth building. That is the cost of occupying the asset. The equity you built in year 1 on a $320,000 home is approximately $3,800 of principal reduction, $3,800 of tangible equity gain against $18,000 paid. Your capital velocity on your largest expense is returning 21 cents of asset value per dollar deployed. 79 cents of every mortgage dollar in the early years of a 30-year amortization schedule is pure interest extraction. And it is perfectly legal, and almost everyone does it, and almost no one calculates it. The 2 car payments at $912 per month total $10,944 per year. Cars are depreciating assets. The average new vehicle loses approximately 20% of its value in year one and roughly 15% per year for the next 4 years. If those vehicles were purchased at $45,000 combined, in 5 years they are worth roughly $16,000 in resale value. The family paid $54,720 in payments over 5 years and holds $16,000 in depreciating metal. The net wealth destruction on those two vehicles over 5 years is $38,720. That is not counting insurance, maintenance, registration, or fuel. That is purely the payment to residual value gap. That number should land differently when you see it written out. $38,720 consumed, not invested, not compounded, consumed. Student loan payments at $420 per month at an average federal rate of 6.5% on a balance that started at $50,000 11 years ago have delivered approximately $55,440 in total payments. If the current balance is still around $22,000, the family has paid $55,000 to reduce a $50,000 debt to $22,000. The net destruction is $27,000 in interest charges paid over a decade, with $22,000 of liability still outstanding. They bought an education. The system is still billing them for it, compounded. Now here is where the compounding lie fully exposes itself. After taxes, mortgage, cars, student loans, utilities averaging $400, groceries at $950, health insurance premiums at $720, childcare or school expenses at $640, phone plans, subscriptions, clothing, and incidentals. This household has approximately $800 to $1,200 per month in discretionary capital, some months less. And they are dutifully putting $400 of that into a 401k at work. They have heard the compound interest story. They have been told that if you invest consistently, time will do the heavy lifting. They have been told to start with whatever you have. They have been told that even $10 a month matters. And here is where I need you to stop and do real math with me, because this is the single most dangerous lie in consumer financial culture. Compound interest has a minimum floor. There is a velocity threshold below which compounding produces results so negligible that inflation literally erases them before they materialize into real purchasing power. Let me prove it. If you invest $400 per month at an average annual return of 7%, a realistic long-run real return for a diversified index portfolio after fees, after 30 years you accumulate approximately $485,000. That sounds impressive until you apply the Consumer Price Index. Inflation has averaged between 2.8 and 3.4% annually over the last 40 years. At 3% annual inflation, the purchasing power of $485,000 in 30 years is equivalent to approximately $199,000 in today's dollars. So after 30 years of disciplined investing, this family's nest egg has the real-world purchasing power of just under $200,000. Meanwhile, the 4% rule of retirement withdrawal tells them they can safely pull $19,400 per year from that portfolio without depleting it. $19,400 per year on a household that was spending over $100,000 annually in working years. The math does not close. The system told them to invest, and they did, and the compound curve at that entry velocity cannot escape the gravitational pull of inflation, lifestyle costs, and time compression. Now let us run the real minimum floor calculation. For compound interest to produce retirement-grade capital velocity, meaning enough real dollar purchasing power to replicate even 70% of a working income, you need a seed capital base that generates momentum faster than inflation absorbs it. Here is the breakpoint. At 7% annual return to produce $100,000 per year in withdrawal income under the 4% rule, you need a portfolio of $2.5 million. To reach $2.5 million in 30 years at 7% compounded, you need to invest approximately $2,260 per month every month for 30 years without interruption. At $400 a month, you reach $199,000 in real purchasing power. You need $2,260 per month to reach the target. That is a 565% gap between what this family is contributing and what the math requires. The start with $10 rule is not a wealth strategy. It is a psychological placebo that keeps people participating in a system that needs their deposits without delivering the outcome it implies. Compounding is real. But compounding below the velocity threshold is like trying to drive a car with a half ounce of fuel. The engine is real, the physics are real, the fuel is not enough to go anywhere meaningful. Now here is what I want you to think about, and I genuinely want your answer on this. If you looked at your actual monthly cash flow right now, not your gross income, your real net after every deduction and every fixed payment, how much discretionary capital do you actually have left to deploy into wealth-building assets? Not what you think you should have, what you actually have. Drop your thoughts in the comments, because the answer most people come to when they do that math for the first time is the beginning of building a real system. Let us go deeper into the structural architecture that the wealthy actually use, because this is not about secrecy, it is about engineering. The reason high-income earners can still feel financially trapped while people with half their salary build real multi-generational wealth is not luck or inheritance. It is a structural difference in how capital flows through their ecosystem. The wealthy do not save money. They build closed-loop capital systems. Here is what that means in mechanical terms. When a traditional employee earns income, the flow looks like this. Gross income flows to the government first via withholding. Net income flows to liabilities, mortgages, car loans, student debt. Residual flows to lifestyle expenses, groceries, utilities, subscriptions. Micro residual flows to savings or investment accounts. Capital exits the individual's ecosystem at every stage. Almost nothing returns. The loop is open. Capital enters once and leaves in multiple directions simultaneously. A closed-loop capital system is architecturally different. Income enters a business or holding entity first, often an LLC, S-corp, or trust structure, depending on the strategy. Business expenses, legitimate operational costs including home office allocation, vehicle business use, equipment, travel, professional development, are paid pre-tax before the income is reported as personal. The business entity then pays the individual owner or operator a lower optimized salary, reducing the personal income tax exposure dramatically. Investment assets are acquired using leverage, other people's money, which means personal capital stays inside the ecosystem while debt capital is used to acquire cash-flowing assets. The cash flow from those assets, rental income, dividend distributions, business profits, re-enters the ecosystem and is reinvested before it ever touches a personal bank account. Tax strategies like depreciation on real estate, pass-through deductions on business income, and tax loss harvesting on investment portfolios reduce the taxable footprint of that circulating capital. The result is a loop. Capital enters, generates returns. Those returns are sheltered from full taxation. The sheltered capital is redeployed into additional assets, and the loop accelerates. Capital velocity inside this system is dramatically higher than any salary-based savings model. Let me give you a concrete velocity comparison. Family A, the one we opened with, earns $140,000 gross. After all extractions, they invest $400 per month, approximately 3.4% of their gross income. They are operating at capital velocity of 3.4%. Family B earns $140,000 gross through a business entity. They optimize their tax structure to reduce effective personal tax to 12 to 14% instead of 26 to 32. They use the saved 12 to 18% in tax efficiency, which equals $16,800 to $25,200 per year, to acquire a small multifamily rental property using an FHA or conventional investment loan with 20 to 25% down. That property generates $1,200 per month in gross rental income. After debt service, insurance, and management, it nets $450 per month in free cash flow. They deploy that $450 plus their now higher discretionary income into a second property 18 months later. The compounding is not happening in a brokerage account at $400 a month. The compounding is happening across a growing portfolio of leverage-purchased cash-flowing assets that multiply their capital without requiring equivalent capital outlay for each new position. This is the architecture of real wealth. It is not passive in the inspirational sense. It is systematically engineered. Now let us build the actual structural blueprint, because knowing the problem without a step-by-step redesign is just anxiety. Step 1 is the capital audit. Before you can redirect capital, you have to see exactly where it is going. This means creating a single-page financial flow document showing gross income, every tax extraction by category, every fixed liability payment with current balance and interest rate, every variable expense by category, and what remains. Most people have never done this calculation in totality. When they do, they find between $400 and $1,200 per month that is leaking into lifestyle inflation they did not consciously choose. Identify that capital first. Step 2 is tax structure optimization. If you have any form of self-employment, side income, freelance revenue, or a business you operate, you need an entity. An S-Corp election on an LLC with annual revenue above $40,000 to $50,000 can save between $5,000 and $15,000 per year in self-employment tax alone. That is free capital that currently exits your ecosystem unnecessarily. Qualified business income deductions under current tax law allow pass-through entity owners to deduct up to 20% of qualified business income from taxable income. If you earn $80,000 in business income, up to $16,000 of that may be deductible, saving $3,500 to $5,000 per year in federal taxes depending on your bracket. These are not loopholes. They are architectural features of the tax code that are used by every wealthy business owner in America and ignored by almost every salaried employee. Step 3 is the liability restructuring sequence. Not all debt is equal. You prioritize elimination of pure consumer extraction debt first. High-interest consumer debt above 8%, credit cards, personal loans, and any variable rate instruments that are not backed by an appreciating or cash-flowing asset. You do not pay extra on your mortgage in year 1. You kill the consumer drag first because consumer debt compounds against you, while mortgage debt is at least partially offset by real estate appreciation. The mathematical sequence is high-rate consumer debt eliminated, then liquidity buffer built to 3 months of fixed expenses, then capital redirected to asset acquisition. Step 4 is the seed capital velocity threshold strategy. This is where the compounding floor becomes a target instead of a trap. The goal is not to invest slowly over 30 years. The goal is to accumulate seed capital above the velocity threshold as rapidly as possible. The threshold calculation is this. Determine what annual passive income you need to cover your baseline fixed expenses. If your fixed monthly expenses are $4,000, your annual passive income target is $48,000. Under the 4% rule, that requires a portfolio of $1.2 million. Under a cash-on-cash real estate return of 8%, that requires $150,000 in equity deployed into income-producing property. $150,000 is reachable as a target in a compressed 5 to 7 year window with the right capital velocity. $1.2 million in a brokerage account at $400 a month is not reachable until year 41. Same destination. Radically different timelines depending on the vehicle. Seed capital accumulation into the right vehicles at the threshold level is the entire game. Step 5 is the automated reinvestment loop. Once you have one cash-flowing asset, the system feeds itself. Rental income is not spent. It is swept into a dedicated business account and redeployed. The first property funds the down payment acceleration on the second. Tax savings from entity structure fund the third. Dividend income from index positions purchased with business capital funds the fourth. Each position in the loop reduces the amount of personal labor income required to expand the system. This is the mechanical definition of financial freedom, not an emotion, not a lifestyle, a mathematical condition in which your capital system generates enough recurring cash flow that your personal labor becomes optional. Step 6 is capital protection and ecosystem sealing. The leak points in most families' systems are not investment returns. They are lifestyle inflation, emergency expenses that have no pre-funded buffer, tax surprises that hit because they had no entity structure, and consumer debt that reaccumulates because the behavioral spending pattern was never re-engineered alongside the financial structure. Sealing the ecosystem means funding a proper emergency reserve in a high-yield savings account, generating 4.5 to 5% yield, not a zero-interest checking account. It means establishing an HSA if eligible and investing those funds instead of spending them, creating a tax-advantaged health expense pool that grows and compounds. It means reviewing insurance coverage to ensure that one medical event, one lawsuit, one natural disaster cannot liquidate the asset base you spent years building. Protection is not a passive step. It is structural architecture. Now let me bring this full circle back to the compounding floor because I want you to genuinely understand why the $10 rule is not just unhelpful, but mathematically cruel when taught without context. Compounding is real. Einstein may or may not have called it the eighth wonder of the world, but the math is not in dispute. The problem is that compounding is not a linear function. It is exponential, and exponential functions have an acceleration point. Below the acceleration point, the curve looks nearly flat. The investor is contributing, the account is growing marginally. Inflation is quietly consuming the real dollar value of those gains, and the emotional reward of watching a small balance grow slowly is the only thing keeping them engaged. The system benefits enormously from that engagement. Banks hold the deposits, brokerages collect the management fees, fund companies collect the expense ratios, and the investor receives a real compounding return of somewhere between 3 and 4% after inflation, and fees on a balance too small to generate life-changing cash flow in a relevant time frame. The seed capital threshold at 7% net returns required to generate inflation-beating, lifestyle-sustaining wealth is approximately $300,000 as a starting balance if you are beginning your compounding journey at age 35. At $300,000 growing at 7% annually, you add $21,000 in year one from returns alone. That $21,000 reinvested adds an additional $1,470 to next year's return. The curve begins to bend. By year 10, your portfolio has grown to approximately $589,000 without adding a single additional dollar. By year 15, you cross $825,000. By year 20, you cross $1.15 million. The compounding acceleration is real and powerful, but only above the floor. Below $300,000 at age 35 investing at moderate returns, inflation neutralizes most of the compounding benefit in real purchasing power terms. The only path through the floor is capital velocity. You have to get above the threshold faster than inflation can consume your slow accumulation, and the only way to achieve that velocity is through the structural architecture we just walked through, not through a $10 monthly contribution into a brokerage account built on a salary with an open-loop capital system. Share this video with one person you care about because the middle-class loop is designed to keep them trapped, not out of malice, out of engineering. The system was designed by people who understood capital velocity, compounding floors, tax structure, and leverage math. It was not designed to teach those things. It was designed to extract from people who do not know them. Sharing this is not a small act. It is the act of putting architectural knowledge into the hands of someone who can use it to restructure their entire financial trajectory before the next decade takes what their current system is already costing them. The math is not complicated. The structure is not secret. The only thing standing between most families and a closed-loop capital system that builds real generational wealth is the sequence of steps executed in order on a timeline aggressive enough to clear the compounding floor before inflation and consumer extraction drain what remains. You can do this. The variables are real. The outcomes are calculable. The system is buildable. And if you want to keep going deeper into the mechanics of how to engineer your personal wealth loop step by step with real numbers and real structural frameworks, subscribe to the channel right now because this is the System Network, and we are just getting started.